Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 139, titled Managing Implied Volatility Risk by Establishing an Initial Time Value Return Goal Range. Now, most of you know that not all securities are the same when we're using these underlyings for our option selling portfolios. In this particular podcast, we're going to be using some real-life examples taken from the BCI Premium ETF report. So let's start off this podcast with discussing the factors that determine our covered call writing strike price selections. So first we have to determine the moneyness of the strike. Are we going to use an in-the-money covered call with a strike price actually lower than current market value and take a more defensive approach to covered call writing? Or are we going to use an out-of-the-money, more aggressive approach where the strike price is higher than the current market value of the stock? That's the first factor. Now, we also have to determine what our initial time value return goal range is. This has to be determined and stated before we enter any option selling trade. So in my case, in normal market conditions, I will look to generate 2 to 4% a month for my initial structuring of my covered call writing trades. I'll go a little higher in bull markets, and I'll be a little more defensive in my mother's much more conservative portfolio. And we also have to determine our personal risk tolerance. How much risk are we willing to take? The greater the returns that we generate from our premiums, that means the higher the implied volatility of the underlying security, which means the greater the risk. Not every investor is the same. So when I tell you what my goal is when I structure a trade, that doesn't necessarily mean it's right for you. You may feel that you want to be a little more defensive than I am, or you maybe want to be more aggressive than I am. That's something that only you can determine. So let's talk about now these time value premiums and as it relates to implied volatility of the underlying security. Now, the amount of time value that our premiums will generate is directly related to the implied volatility of the underlying security. So based on the market pricing over the next 30 days, the implied volatility will tell us how much price movement the market is anticipating in an annualized basis based on one standard deviation. So once again, the greater the returns, the greater the implied volatility, and therefore the greater the risk. Now, as I said before, my initial preference for 1 month contracts is 2 to 4%. And that's basically for near the money strikes. Now, most of you know that I also have developed ultra conservative strategies for covered call writing and selling cash secured puts. I'm now referring to traditional portfolios. Now, I'll go up to 6% in confirmed bull markets, where I have the market trend with us. So I might go as high as 6% for my initial time value return for 1 month near the money strikes. But that's only in strong bull markets. Typically, I'll keep to within that 2 to 4% framework. Now, as I said, this is right for me. Is it right for you? You tell me. Now, we're going to be comparing the implied volatility stats taken from one of our premium member ETF reports dated 3/10/21 and show you how these figures align with our premium time value returns. So you'll actually be able to see a real life example where the implied volatility is in fact directly related to risk and actual premium returns. So for those of you who are also watching this podcast, I now have a screenshot of that report from 3/10/21. For those of you who are just listening, I will describe it for you. I've highlighted in 3 of the brown rows 3 different ETFs. The top row is XOP, Spider S&P Oil and Gas Exploration ETF, which shows an implied volatility of 5217. Now above that, the implied volatility of the S&P 500, the total market, is 1899. So XOP with an implied volatility of 52 is more than double that of the S&P 500. So that would be our middle of the three implied volatilities, because I'm going to show you now a much more conservative implied volatility and a much more aggressive implied volatility. So XOP is the first security we're going to look at. Now the low end of the implied volatilities is VYM, Vanguard High Dividend Yield ETF, which had an implied volatility on 3/10/21 of 17.54. So that aligns almost exactly with the implied volatility, which was almost 19 of the S&P 500. And all the way at the bottom of the screenshot, we have BLOK, Amplified Transformational Data ETF, which had an implied volatility of 9413. So that was the highest IV of the three. So once again, starting at the top, XOP had an IV of 5217. The middle one, VYM, had an implied volatility of 17.54, the low end of the IVs. And then at the very high end of the IVs was BLOK, which had a IV of 9413. So we would expect the lowest premium returns for VYM, then the middle one for XOP, and the highest returns of BLOK. That's what we would anticipate based on these implied volatilities. Now we're going to look at an option chain and put this into the one of the BCI multiple tab calculators to actually see our results for BLOK, VYM, and XOP. Now, we said that BLOK was going to have the highest returns because it had the highest implied volatility. So if we put the information, the security trading at 56.72, and we're going to look at the in the money 55 and the out of the money 58, both of them near the money strikes, one higher than current market value, one lower than current market value. We put in the premiums from the option chain, and we get these results. The return on our option time value only is 9.1% for the in the money 55 strike and 9.3% for the time value for the out of the money 58 strike. Now, of course, out of the money strikes give you upside potential as well, in this case 2.3%. So there's an opportunity here for a 7-week return of 9.3 plus 2.3 or 11.6. Now for the in the money 55 strike, there's no upside potential because we're agreeing to sell our shares at a lower price than current market value, but we do have some downside protection of that time value profit, in this case 3%. And that means that if the security drops by 3% and no more, we are guaranteed that 9.1% 7-week return. So you can see that we have a very robust return for this high implied volatility security BLOK. Now, if we look at the other end of the spectrum, VYM, which had the lowest implied volatility, you could see that the return on our options for the in the money strike was 1.4%, and for the out of the money strike was 1.2%. Remember, these are 7-week returns. Now, there was an opportunity for the out of the money strike for an additional 1.4%, so there was an opportunity here for a max return of 2.6% for the 7-week return. Now, as far as downside protection for the in the money strike, 1.6%. So VYM can drop by 1.6% over the next 7 weeks and no more, and we are guaranteed that 1.4% initial time value return. Now we move on to XOP, which, if you recall, was the middle of the implied volatilities, and that was 5.7% for the in the money strike and 5.5% for the out of the money strike. The additional upside for the out of the money was 1.6, meaning we can have a potential 7.1% 7-week return. The downside protection for the in the money strike was 1.9%, and that means that we would be guaranteed a 5.7% 7-week return as long as XOP didn't drop by more than 1.9% by contract expiration. So you could see the lowest implied volatility VYM was in the 1.2 to 1.4% range. The middle one, XOP, was in the 5.5 to 5.7% range regarding 7-week initial time value returns. And the highest implied volatility, BLOK, was in the 9.1 to 9.3% range. So it does align with the highest implied volatility, highest returns, lowest implied volatility, lowest returns. Now, if we were just to convert this to a monthly and annualized returns, so we can kind of simplify it a little bit rather than use 7-week perspectives. For BLOK, the most aggressive, the 1-month return was 5.7, and the annualized return was 68.3. VYM, which was at the other end of the spectrum, the most conservative, had a monthly return of 0.80% and an annualized return of 9.7%. And the middle one was XOP, which had a monthly return of 3.5% and an annualized return of 41.6%. Now, for me, I told you my goal for initial structuring is normally between 2 to 4% in normal markets, and that would be XOP, would be the one I would focus in on of these three. Now, in strong bull markets, I would consider BLOK at the 5.7. Remember, I told you I'd go up to 6% in very strong bull markets, but never higher. And in my mom's account, a more conservative account, VYM would be the way to go in my mom's account. So a more conservative, more defensive approach to covered call writing. So let's summarize this now. Implied volatility is critical to our option selling success, and as well as far as making our option trade structuring decisions. It will define our premium returns because IV and time value returns are directly related, but it also measures risk. So the greater the implied volatility, the greater the risk, and vice versa. So before entering our trades, we must establish our initial time value return goal range for that specific time frame. Now that will also be determined by our personal risk tolerance. So what is our goal in terms of time value premium we're looking to generate within that time frame, and how much risk are we willing to incur? And because implied volatility is directly related to time value, it's not really necessary to look up specific IV stats, because if we set our goal at 2 to 4%, we know where the implied volatility is. It's going to be within our comfort level. And so we just really need to look at the time value return premiums for near the month 1-month returns. Now, if we're using weeklies, we would just convert it to weeklies. If we're using longer term options, which I don't subscribe to, but everybody's entitled to trade as they see fit, you can always make an adjustment in that regard as well, relating to your initial time value return goal range. So all of this is thought out ahead of time, and then that will make our trading decisions so much easier as long as it fits within the framework of our strategy requirements and our strategy goals. Ladies and gentlemen, for those of you relatively new to covered call writing and selling cash secured puts, I'd like to tell you about our BCI package, our best and most comprehensive educational package ever offered by the blue collar investor. Those of you looking at the screenshot, you could see it has 18 components to it, 6 online video courses with downloadable workbooks, 6 calculators invented and created by the blue collar investor, found nowhere else, 5 of our best-selling books in ebook format, and our premium membership, which is an annual subscription for 13 months, which includes 4 reports of eligible securities, as well as a huge training program right now, well over 200 training videos and expanded calculators and much, much more. So the 18th component has well over 200 components in and of itself. To find out more information on our BCI package, go to our website, thebluecollarinvestor.com, and click on the BCI package link at the top of the web pages, and you will have information as well as a short video describing the benefits of this package and the discounted rate. For those of you who'd like to get items purchased individually, just go to thebluecollarinvestor.com/store, and you can look at our video lessons, our ebooks, our hard and soft covered books, our calculators and spreadsheets. We also have a mentoring program as well. So, folks, that ends this BCI podcast number 139, titled Managing Implied Volatility Risk by Establishing an Initial Time Value Return Goal Range. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.